While you were watching silver collapse from its highs, staring at the chart in disbelief, someone else was doing the exact opposite. They weren't panicking. They weren't hesitating. They were buying aggressively, not retail investors, not small traders. This was nation-state level accumulation, the kind of buying that leaves fingerprints in the data. And what those fingerprints reveal is shocking, because this isn't just a random bounce or a temporary spike. The charts are pointing towards something much bigger, something mathematical, something inevitable. By the end of this video, you still understand why $300 silver isn't tea-crazy. It is history repeating itself. For nearly half a century, silver has been the most manipulated and misunderstood commodity in the global financial system. Think about it. From 1980 all the way to 2025, silver remained trapped in a massive range between roughly $4 and $50. Every time it approached that ceiling, it was slammed back down. 1980, rejected. 2011, rejected again. And for decades, the world accepted this as normal. Analysts repeated the same script over and over. Silver is a $50 metal. Investors were conditioned to believe silver could never escape that cage. But here's the real issue. Silver was the only major commodity that never repriced properly. Gold broke above its old highs. Copper exploded after decades of compression. Oil surged into new realities. Even obscure industrial metals eventually broke free. Silver was the exception. For 50 years, silver was held below its historical potential, while every other commodity adjusted to inflation, monetary expansion, and rising industrial demand. That suppression created something dangerous: pressure. Markets don't stay compressed forever. When something is held down for decades, it doesn't release slowly, it releases violently, and that's what we're seeing now. Silver finally broke above $50, the ceiling that defined an entire generation. That should have been front-page news. That should have been treated as a paradigm shift. Instead, mainstream media barely touched it. Because if silver is truly breaking into a new range, then everything changes. Currencies, inflation hedges, industrial supply chains, and the future of hard assets. And the scariest part? Most investors are still thinking in the old reality. They're using old indicators, old expectations, and old psychological anchors. But silver is no longer playing by the old rules. The market has entered a new phase, and most people don't even realize it yet. Now here's where it gets insane. When I went back through modern silver history, I discovered a pattern so consistent it almost felt scripted. In 1979, silver didn't climb gradually. It detonated, going from around $12 to $50 in just 5 months. In 2010, the same thing happened again. Silver surged from $18 to nearly $50 in only 7 months. 2 different decades, 2 different economic environments, same exact structure. Month 1, acceleration. Month 2, breakout. Then a brutal correction. Then the real move begins. That correction is always the psychological weapon. It shakes out weak hands. It convinces people it's over. It creates maximum fear right before maximum upside. And what just happened in 2026? Silver exploded above $90, then crashed violently in a day and a half. Everyone panicked. Headlines screamed, "Silver bubble burst." Analysts declared the top was in. Retail traders dumped positions. But the chart? The chart says this was month 2. If the pattern holds, and it has held twice before, then the real acceleration happens in months 3 through 6. That puts the explosive phase directly into early summer. But this time, there's a difference. In 1980 and 2011, silver surged, but it was still trapped under the $50 ceiling. This time, that ceiling is gone. Silver already shattered the 50-year barrier, and even after crashing, it never fell back below the old range. That means the old ceiling has become the new floor. This isn't a spike. This is a launch pad. And the next phase won't be measured in 10% moves. It will be measured in multiples. Because when a commodity breaks free after 50 years of compression, it doesn't politely drift upward. It reprices violently. And that's before we even talk about what's happening in China, India, physical supply shortages, and the silver premium that is exposing the paper market as a complete fiction. Stay with me, because what comes next is where the $300 target stops sounding insane and starts looking inevitable. For decades, silver has been treated like the forgotten metal. Gold was always the king. Oil grabbed the headlines. Stocks stole the spotlight. And silver? Silver was left sitting in the corner of the financial world, dismissed as nothing more than an industrial commodity. But that story was never true, because beneath the surface, silver was quietly becoming one of the most compressed, most manipulated, and most explosive setups in modern market history. Think about what happened over the last 50 years. From 1980 until 2025, silver was trapped inside a prison, a massive range between roughly $4 and $50. Every single time it approached that $50 ceiling, it was rejected violently. 1980, slammed down. 2011, slammed down again, and the world accepted it. Investors were trained to believe silver was incapable of breaking free. But here is what most people missed. Silver was the only major commodity that never repriced properly. Gold broke above its historic highs. Copper exploded after decades of sideways movement. Oil surged into new realities. Commodity after commodity eventually broke free from long-term compression. Silver was the exception. And when something is held down for 50 years, it doesn't stay quiet forever. It builds pressure. Markets are like physics. Compression creates energy. The longer something is suppressed, the more violent the release becomes when the barrier finally breaks. That is exactly what silver has begun to do. When silver finally broke above $50, it wasn't just another rally. It was the first crack in a dam that had been holding back decades of accumulated force. And once a dam cracks, it does not heal. It bursts. The breakout began in late 2025. Silver started accelerating in November. That was month 1. December pushed higher. Month 2. Momentum began building rapidly, and by the end of January, silver surged above $90. Then came the crash, a brutal, gut-wrenching collapse in barely a day and a half. Prices fell so fast that even experienced holders felt sick watching the screen. And instantly, the narrative returned. Silver is done. That was the top. It was a bubble. You should have sold. But that reaction is exactly what always happens. Because silver has done this before. When you study the major surges in modern history, a pattern emerges that is almost impossible to ignore. In 1979, silver went from around $12 to $50 in just 5 months. Not 5 years, 5 months. In 2010, silver surged from $18 to nearly $50 in only 7 months. Both moves followed the same structure: acceleration, breakout, then a terrifying correction. Then the real move begins. That correction is not random, it is psychological warfare. It exists to shake out weak hands, to convince the public the rally is over, to create maximum fear right before maximum upside. And what just happened in 2026 looks identical. Silver surged, then it crashed. Weak hands sold, confidence collapsed. But historically, that crash is not the end. It is the midpoint, the reset before the final acceleration. And this time, something makes the setup even more extreme than anything we've ever seen. The physical market is breaking away from the paper market. In Shanghai, silver has been trading at a massive premium above Western prices. Not a couple dollars, not a small temporary difference. A $30 per ounce gap. That is not noise. That is the real physical market screaming that the paper price is disconnected from reality. And why is that happening? Because China has effectively trapped global silver supply within its own borders. Export controls implemented in January 2026 mean only a limited number of state-approved companies can export refined silver. That locks up as much as 60 to 70% of global refined supply. The result is simple: scarcity. Bullion dealers across North America are warning clients that physical silver deliveries may come with discounts or delays because supply is so tight. Read that again. Dealers cannot source enough metal at spot pricing. That is not a healthy market. That is a market fracture. And throughout history, whenever physical premiums widen like this, the paper price eventually rises to meet reality. It never works the other way around. The paper price does not drag physical down. Physical drags paper up. Then comes the first demand wave: industry. Silver is essential in solar panels, AI infrastructure, electronics, and medical devices. It is not optional. It is not replaceable. China produces the majority of the world's solar cells, and every single one requires silver. Global demand has exceeded supply for 5 consecutive years. 5 straight years of deficit, and unlike gold, silver is consumed. Once it goes into a circuit board or a solar panel, it is effectively gone forever. The amounts are too small to recycle economically. That means industrial demand permanently removes silver from the supply chain. But then comes the second wave, the wave that changes everything. Silver is money. It has been money for 3,000 years. And now something extraordinary is happening. Silver is being remonetized. India is preparing to recognize silver as formal bank collateral starting April 1st, 2026. That means 1.4 billion people are about to gain access to silver, not just as a commodity, but as a monetary asset. That is historic. When silver acts only as an industrial metal, demand grows steadily. But when silver acts as money, demand becomes vertical. That is why gold has been making new highs. Gold rides the monetary wave. And silver has always followed gold, just with a lag. Right now, that lag is extreme. The gold to silver ratio remains stretched near historic levels, meaning silver is still absurdly cheap relative to gold. Not slowly, violently. Now combine everything: industrial deficits, monetary demand unlocking, China restricting exports, physical premiums exploding, paper markets losing control. This is not a setup for a small move. This is the foundation of a paradigm shift. Silver is no longer trapped in the old world. The $50 ceiling is shattered. The floor of the new reality is the ceiling of the old one. And if history rhymes the way it has twice before, then the real move has not even started yet. Now let's connect the dots, because this is where the silver story stops sounding like speculation and starts looking like mathematics. Most people think silver moves randomly, up one week, down the next. But history shows something very different. Silver doesn't climb in slow, predictable steps. When it breaks out, it explodes. And those explosions follow a pattern that has repeated with frightening consistency. Look back at the two biggest modern silver surges. In 1979, silver went from roughly $12 to $50 in only 5 months. That was not a gradual bull market. That was a detonation. In 2010, silver surged from about $18 to nearly $50 in 7 months. Again, not slow, not gentle. Fast, violent repricing. Both of those moves shared the same structure: acceleration, breakout, a brutal correction, and then the final vertical phase. And here's the key point. Both of those historic surges were capped by the old ceiling. Silver hit $50 and slammed into resistance that had existed for half a century. But this time is different. Silver has already broken through that ceiling. The 50 wall that rejected silver in 1980 and rejected silver again in 2011 has finally been shattered. And even after the violent crash from $90, silver did not collapse back into the old range. That tells you something enormous. The old ceiling has become the new floor. This is not silver returning to normal. This is silver entering a new price reality. Now let's talk about why $300 silver is not crazy. It's not a fantasy number. It's not hype. It comes from historical normalization. Gold has always led the monetary metal cycle, and silver has always followed, just with more volatility. The gold to silver ratio is still stretched near extreme levels, meaning silver remains historically cheap compared to gold. Every time this ratio becomes this distorted, silver violently reprices higher to close the gap,